All righty. Hello, and welcome. Pardon me. There we go. Hello and welcome, ladies and gentlemen. I want to welcome everybody back to the FX Breakthrough Bootcamp. My name is Manny Q. I'm going to be your host and your trainer for today. So I'm so excited to be able to be here with you guys for day 4, volume 4 of our FX Breakthrough Bootcamp. Love to see who's actually tuning in with us right over here. So I see we have Grace from Kenya. How are you? Oh, Grace from Kenya. Oh, and her name is Grace. How you doing? We have Liverpool, UK, Spain, Florent from Germany. We have Switzerland, France, Norway, London, Black Forest. Really love that. Southwest Germany. Hello from Austria. Some more Switzerland, South Florida, Mexico. There we go. Chicagoland, more UK, New York, South Africa. Let's go. We have Ghana, Amsterdam, Bronx, Italy. Wow. Ithileunia. Might have pronounced that wrong, right? Gstaad. I don't know these places, but I want to welcome everybody here to the call today. All righty. So as we get ready to begin and jump into today's bootcamp, let's actually start off by reminding everybody that this FX Breakthrough Bootcamp is a beginner bootcamp series that's designed for somebody who is looking for a foundation in the day trading market, right? So this is going to be for the individuals that want to know, okay, how do I go from point A to point P? How do I go from being a noob to getting a foundation to becoming a professional within the market? You know, that's what this bootcamp is all about. So many people want to have success, but they're standing on a shaky foundation. And the entire purpose of this 5-day free FX Breakthrough Bootcamp is to provide you a solid foundation. And now over the next 3 weeks, as we continue our boot camps, they're going to get more intensive, but they are going to be for active paid members that are within our network. But this foundational education here will really stand firm and allow you to continue growing. So let's begin with our bootcamp by actually recapping what we went over in our previous course. So our previous course, volume 3, this is where we decided to start getting into the basics of risk management. We started talking about real-time use and how to look at the 3 components, such as risk per trade, your stop loss and take profit, and also your risk to reward ratio. So we started looking at that, how to calculate your lot sizes, things of that nature. We actually got into the benefits of using risk to rewards and showing risk to reward examples on how somebody, when they have proper money management and proper risk to reward, they could be as little as 30% accurate, but still be profitable at the end of each week. And then from there, we continue to show how you can actually increase in your profitability if you have a good risk to reward ratio and your win rate has improved just a little bit. And that's when we actually went over into the compound trading plan, which is a completely free resource that I provide for our members right over here within the community. And this allows you to, again, remember, put in your starting balance, your ending balance, your risk per trade, stop loss TP, and it will automatically generate a completely customizable trading compound plan for you to show you how to get to your goals. So it makes it very easy. And this has been a huge tool that has allowed me to become more successful in my trading, as well as the mentees that have been working with me here. And then from there, we actually got into trade management, right? Because that's the second half of the battle, is once you're in the market, right? It's like free falling. You're in the air. After that, you got to know what you're doing to survive the market. So that's where we went into 6 key concepts of trade management. Pardon me. We talked about breaking even on a trade, never letting a winner turn into a loser. We talked about going risk-free, which is the same side of the coin of break even, but this is when the trade is actually going profitable. We talked about how to trail stops, and we started giving real live examples of a gold trade that we were in. From there, we talked about taking partials and how you can take partials and remain in your position, but secure that equity. We talked about stacking orders, over there, right? Getting in, doubling, tripling your percentages and some of your profits potentially by getting in the market at the right place at the right time when it's moving in your favor. And then we also talked about avoiding news and how avoiding news is actually a phenomenal way for you guys to mitigate and manage your risk if you're completely new to trading, because why would you put yourselves at risk of trading in a volatile market if you're still, you're not quick to adapt in the market yet. So it was a phenomenal course. And now what we're going to do as we get ready to go into volume 4 today, we're going to actually start getting into the thick of it just a little bit. Now, as you guys remember, in our first course, we talked a lot about what is Forex, the history of Forex, right? And we went through the entries and the stop losses and the take profits and the lots and those different type of things. And then in course 2, we actually talked about the different type of analysis, actually participating in the market, interacting, with the market. We started talking about those things, market sessions. And you've seen me constantly switch back and forth to a platform. And then in our previous lesson, as we just talked about, we talked a lot about surviving the market. So now this time we're going to actually talk about, for volume 4, we're going to talk about engaging inside of the market, right? So one of the number one tools that you guys are going to use is a trading platform. Remember, the trading platform allows you to interact with the market. So that way you can start marking up and having your analysis, creating a bias, determining if you want to buy and sell, when you want to buy and sell, things of that nature. So we're going to introduce you to Tradingview. Now, Tradingview is one of the most commonly used platforms in the entire world. Well over 50 million people use the Tradingview. So we're going to provide an introduction to Tradingview. And I just noticed over here, I did not change that text, so bear with me right over there. But let's actually talk about the benefits of Tradingview. So Tradingview is going to provide advanced charts. It's going to allow you to, interact with the market. It's going to provide you with technical indicators, which we're going to cover a little bit of today to help you read the market. It's going to allow you to have drawing tools to start interacting and becoming very specific with what you're looking at in the market. Trading alerts, that's going to be something later down the line when you're ready to trade, when there's an area of interest and you might want to buy or sell. You can actually set an alert at those areas and get those alerts delivered to you in real time. Financial analysis, for those of you guys that are looking at those fundamental analysis. Market data coverage, you can get historical market data. Pine script, you can start developing your own codes. And actually, you can do a broker connection. So depending on the country that you are in, Tradingview does allow connections to a live broker account. But the broker account, they only work with specific brokers that are fully regulated with a government body in your particular country, and then they're licensed through Tradingview. So if you end up having a broker on Tradingview, or you're always welcome to open up a paper trading account, which is just a demo account on Tradingview, you can actually start trading on your Tradingview, which is amazing. So you can execute your trades, you can look at the market, and it's kind of like a one-stop shop. So it's really phenomenal. All righty. Now, this is what Tradingview looks like right over here. Now, as you come to Tradingview, the main page is going to look a little bit different. But as you actually come into the Tradingview platform and you get into a super chart, let me actually show you guys how this works quickly. Okay. You got my personal emails. That's not good. Okay. So I'm going to crop that out of the video, okay, before I get this going. So this is Tradingview right over here. Now, once you take a good look at Tradingview, Tradingview is going to have a lot of different customizations. You're going to have a left-hand menu, a right-hand menu. You're going to have a top menu. You're going to have a bottom menu, and then you're going to have a little bit of a toolbar. So if this is going to be your first time using Tradingview, there's plenty of free videos that you guys can watch out there. But just so you guys have a basic understanding of what Tradingview is, on the left-hand side, this is where we have all of our trading tools. So when you're ready to start drawing up on the chart and you're ready to start interacting with the market, and you want to use trend lines and horizontal lines and parallel lines, and you want to start looking at arrows and boxes and things of that different nature, this is going to be here on the left-hand side. Now, remember, the main tool is going to be here, but there's going to be a small arrow and that arrow will open up a drop-down menu for you to look at additional tools. Now, if there are any tools that you like and you're going to continue to use, you can actually star it right over here. And once you click star, you're going to have this little handy dandy toolbar that's going to come over here with all of your favorite tools that you can just quickly grab and then start using inside of the market. So you don't have to fiddle back and forth with the left-hand side. All righty. And if you ever want that to disappear on the lower left-hand side, you can just simply click this little star icon as you see over here, and the toolbar will go away or the toolbar will come back. So you'll see a lot of these different type of things over here. You'll also get this really cool measure tool. This is where you've seen me in the previous free lessons where I was measuring the movements of the market. And you'll see right over here how many pips the market went, how many bars or candlesticks were there, the time lapse, how long did it take for that move to transpire. On the top hand side here, you now have some of your time frames. So here you can feel free to open this up and choose between different pairs you want to work with, or you could simply type on your chart if you're looking for a particular pair. So let's say you're looking for a GBP, right? You simply type and the menu will come up, and then you can look for any pair that you want to trade right over here. You could even check between stocks, funds, futures, cryptos. The whole entire nine is going to be right over there for you guys as well. And then when you take a look at the top, you'll notice that you have several time frames right over here. Remember how we talked about the candlesticks, and you can start to look at different time frames on the chart. So over here, you can also star these little time frames, and you could put your favorite time frames right at the top. Now, some of the most common time frames that people use is they will use mostly the daily or sometimes the weekly, but mainly the daily to get a really good view of the market. The 4 hour is extremely popular. The 1 hour is very popular. Then the 15 minute, the 5 minute, and the 1 minute. These are the most common time frames that are used within the market. So you can feel free to star those, and then you could just simply click on those right over there. And as you see here, you'll just, it'll just start changing the time frames, and everything on the market will trade. You also have this really cool back and forward feature. So if you're ever drawing up or marking up on the chart, you're doing something, or let's say you had something drawn up and then you deleted it by accident. And say I want to delete it say I deleted it by accident. I want to get it back. You can actually click back on the chart, or you could just continuously click back or forward on the chart. Lots of amazing features, and you'll learn more about them as you guys are starting to work with us right over here. Now, going from here on the right-hand side, you're going to notice there's this huge indicator plane over here. So if you click on the top one, this is where you'll be able to completely create what we call a watch list. So these are going to be all the pairs that you want to actively watch or have quick access to. So you can always come here right there to that little plus icon, and you can add any symbols that you like right here to your watch list. And from there, you can also create sections. So you can start to create sections, and you can divide your sections by pairs or asset classes, or you can create multiple different watch lists right over here. So there's so many different things, and you can see your alerts will be over here. You can start to see messages. You can get a little bit of a news feed. So, as you start exploring more of the TradingView community, you'll have all these great little bells and whistles. But mainly what we use TradingView for is simply this watch list right over here to the right-hand side, the drawing tools on the left-hand side, which we will go through today, and then this top menu. All right, those are the main things that we really use here on TradingView. All righty. If you guys ever want to customize your screen or the look or your TradingView, you guys can simply come right over here to that little tool icon, right? You see that little chart settings? You can actually click on that chart settings, and from here, you can actually start to change the color of your candlestick. So lady, if you guys want hot pink candles and black candles, you can do that. If you guys want to change the color of your background, you can actually do that, right? If you want to go from a solid to a gradient, you can do that. You can literally do whatever you want right over here, and you can even create templates. So as you see, you'll start to create templates, and the market will make different type of templates right over here for you. So you see this popular gray templates, white templates. You know, this is the template I like with black and white candles, right? So you have all these, all those different templates that you have right over there. Let me see if I can actually go back to the white template over here. Okay, I actually lost my entire template. Maybe current. Nope. All righty. Well, I lost my template, guys. That's great. Okay, because I didn't have the last one saved. Oh man, that's great. All righty. Let's see. Yep. All right. So I just use this one, but I like to actually have the candles changed different colors, but all good. All righty. So there we go. So this is Tradingview. All right. Now let's actually get into the thick of it. Now, the first thing that we want to talk about today is we're going to start going into technical price concepts. And today we're going to cover the basics. These basics are designed to help give you guys a better understanding of how to read the price movements, because we covered everything else. So the only thing that's really left is actually understanding what you're looking at over here. So that's what we're going to go through today. We're going to give you guys a basic understanding of how to read this chart with what we call price action concepts. All right. Now, this is the very basic, most foundational, most fundamental way of understanding what price is doing and looking at price. Above price action and in the future, as you guys start to go into strategies, you guys are going to start uncovering really advanced ways of how to read and identify the market. So we're going to give you the basic foundation, and every trader needs the basic foundation. So let's talk about it. Forex price action refers to the study of historical price movements in the foreign exchange market to make trading decisions. So it's the action of price. Now, traders who use price action analysis observe and interpret the price movements on the charts to identify trends, key levels of support and resistance, and other signals that's going to help them predict future market movements. So that's what we're going to do. We're going to start to look at the highs and the lows, and we're going to start to just analyze all of these movements in price action to make sense of what the market is currently doing and where the market can go next, so we could start to generate some ideas on where we may want to put in buys or where we may want to put in sells in the market to potentially earn some profits. So the first thing that we're going to cover is we're going to cover highs and lows. So in the context of Forex trading or any financial market, high and low refers to a specific price levels reached by an asset or pair during a given period of time, such as a day, a week, a month, or even a single trading session. So as an example, let's say we're looking at the market over here. We can see that from this point to this point, this market was the high point and this market was the low point. That's simple. There's the high and there's the low. Very, 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 very simple to see. So think of the high and the lows as valuable data that will begin to help us understand the construct of the market. What do I mean? I mean that if we're starting to look at the market, okay, let's say we're looking at the market, think about this over here. Here goes the high, and then there goes the low. So if this is the low, then here is the high. And then if this is the high, let's come back here, this is the low. And if this is the low from here to here, this is the high. And if this is the high from here to here, this is the low. So this is the concept of high and low. It's whenever we're looking at the market and we're saying, okay, this market is at a low point and this market is moving to a high point. Or we could say this was the previous high point and this was the previous low point right over there. Okay, so this is the concept of high and the concept of low. Every time we identify a high and we identify a low, we can look at this as market data. everything beyond this is going to stem from understanding the concept of highs and lows. So every single time you see price hit a very particular area and reverse and start to come down, this is now a low point. And if it reverses from here and it starts to move its way back up, we are now at a high point. So that's the concept of highs and lows. They are very, very, very important market data points. Now from here, let's talk about what are higher highs and higher lows. So the market is a constant repetition of highs and lows as the price is fluctuating, right? As the candles are going up and down, overall, the market is making highs and the market is making lows while the price is fluctuating and assets are exchanged. So throughout this continual series of highs and lows being formed, this is where we'll start to see higher highs and higher lows being formed. So as an example, let's say we're taking a look over here. You'll notice we have a low point, and then you'll notice we have a high point. And from that high point, we'll notice that the market has pulled down to create a new low point. And we see that this low point is higher than the previous low point. Now from here, this new higher low starts to go and it moves above the previous high. So if this was the previous high and we go right over to the right, we can see that the market is now going above the previous high. And then eventually, this is what starts to create a higher high. All righty. And that's this. So remember, a new high, when a new high is higher than the previous high, this is how we create a higher high. And when a new low is higher than a previous low, this is how we determine and create a higher low. So when we start to see this sequence of low and higher low and higher high and higher low and higher high, this starts to create, this is the formation of what we call a bullish trend. So you ever heard people like that, the stock market is bullish, crypto is bullish, gold is bullish. Well, how do we know that gold is bullish when it is bullish? We know it's bullish by the sequence of highs and lows. So a bullish market makes a sequence of higher highs and higher lows. So if we're coming over here to the market, let's take a look right over here. If we're looking at the market, let's actually remove these drawing tools. If we're looking at this market right over here, we can see that we have the market low and the market now pushes up to a high. And from this high, we can see that this market starts to push down. Now, remember, when we look at the candles, you see how we have some bear candles, and then we have some bull candles, and some bear candles, and bull candles, and bear candles. That's the price fluctuating. That's the market, going up and down within that time frame. Those are the pips fluctuating, right? And we're obviously able to earn on every single pip that the market moves. But the price fluctuating is one thing. The direction of the market is another. That's what we're focusing on, right? So we're not focusing on the noise that's right over here. We're not focusing on the candles fluctuating up and down. That's not what we're doing. What we're doing is we're focusing solely on the overall direction and the formation of the market to identify if this market's starting to make a bullish trend. So as we see here, we have a low point followed by a high point, followed by a low point. And as we see here, as this market started moving above and creating a new high point because it went above this previous high, we could see that this low is higher than that previous low. We could see that this high is higher than that previous high. And as that market pulls down, this is higher than that low, and that goes up, and this high is higher than that high. And then as it pulls back down, this low is, well, that's a bit of an equal low. And as we come back up, that's a bit of an equal high. But as we look at this, let's just take a good look at this over here. Let's try to back this all up over here. Okay. We can see overall that this market is making a series of higher highs and higher lows inside of the market. That's how we know that there is a bit of a bullish trend. Now, if we take a look at other points in the market, you'll see that sometimes, other trends in the market are more steep, right? So let's take a look. It's the same concept. The market goes low to high, to low, to higher high, to higher 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 low. I think you guys are getting the point. Like repetition will really burn it into your minds. To higher high, to higher low, to higher high, to higher low, to higher high. So as long as the market is making that formation of new higher highs and new higher lows, ladies and gentlemen, we are in what we call an uptrend. Okay. Now, from here, we also have something known as lower highs and lower lows. So lower highs and lower lows is the same exact concept, except in reverse. When we start to see the high and the low, and we start to see the lower highs and the lower lows, and the lower highs and the lower lows, what we're seeing over here is we're seeing that formation, right, starting to create a bearish trend or a downtrend. So this is how we know when the market is bearish. Right? You watch on television, the Dow Jones is bearish. It's down, it's negative, all these points. Well, how are we able to identify a bearish market? Well, it's very simple. Let's take a look right over here. It's the same exact concept. So let's come over here. Let's get this, and let's actually try to make this a little bit thicker over here so it's a little bit easier to see. Okay. So let's take a look. This market goes from high, and we can see here the market swings down, and even internally we have low, lower high, lower low, lower high, lower low, right? You have these lower highs right over here, lower low, lower high, lower low, lower high, lower low. And now this market is pulling up to a potential, somewhat of a lower high, right? Potentially. So this right here, this is how we're able to understand that the market is actually going in a downtrend. So remember, the only way that we're able to accurately understand the formation of the market is by understanding the high and the low points. So when you guys are looking at the market, that's what I want you guys to look at. Take a look here at the market, and I'm going to put the trend line back, the high and lows. So as we take a look, I want your eyes to start recognizing each of those swing points in the market. Because remember, those highs and those lows, those are the most valuable data points that everything is going to be based off of. So you want to get really good at identifying those base points right over there. Okay. Now, as we move on from here, we're now going to start to introduce you to trend lines and channels. So what is a trend line and what is a channel? So trend lines and channels are tools that are used by traders to identify and visualize trends in the financial market. So they help traders make decisions based on the direction and the strength of the market movement. So let's take a look over here. A trend line is a straight line that connects two or more points on a chart. What are those 2 points? The highs or the lows. If you are in an uptrend, you're going to connect the low points to establish a trend line. If you are in a downtrend, you're going to connect the high points to make a downtrend. Okay. So this is used to represent the direction of and the slope of a trend. So as an example, let's take a look at this market right over here. We can see from this market that the formation of this market is already bullish. We can see that the market is low. It went high. It has a higher low. It now has a higher high. It has a higher low, and it has a higher high once more, right? We see the formation is bullish, higher highs and higher lows. Now, if we want to visually map out that trend line to help us make trading decisions, okay, we have to do that by connecting two points to establish a trend. So for a trend line, we're going to start a trend line by connecting the first 2 price points, 1 and 2, and then it will create a trend line in the future. And what happens is you'll notice that price will often come back to that trend line, and it may very well respect that trend line, and you can start to make trading decisions based on the market coming to that trend. And we'll talk about that a little bit later. Now, trends are subjective. They're not the end all, the know all, or the be all. And trends are always changing based on the market highs and lows and the sequences as they trade, right? But it's a good concept for you to know. So as an example, let's say I'm looking at the market right over here, right? So if I'm looking at the market and I want to start a trend line, I would come here to the left-hand side of the screen, and then you'll see the tool says trend line. So you're going to grab that trend line tool, and you want to go all the way from the wick, right? Let's remove all these drawings. You want to go from all the way to the wick or all the way to the top. You want to get that high point, and you want to connect it with another high point right over there. So once you connect the high point to the other high point, you could do a few different things over here. Okay. Now, what you could do is you could come here and you could put extend the right line, and then it will extend out forever and you have a trend line. Or you could just simply unclick that and then just drag the trend line. All right. And then what that does for you is this starts to create what we would call a trend line, right? We're taking the two high points, 0.1 and 0.2, and we've created a trend line. And if price is under this trend line, while in a bearish formation, making lower lows and lower highs and 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 lower lows and lower highs, right? We understand that this market is in a downtrend. All righty. Now, if we want to make something of an uptrend, it would be the same but opposite, right? So we would come here, we would get another trend line, and then we would start to connect some of the points on the trend line. Okay. Now, again, as you see over here, you notice how the trend lines, you could potentially have a trend line here. That looks a little crazy. There's actually a degree in which the trend needs to be. You know, you can have maybe that trend line, you know, right over there. You could do something like that. If the trend's already established, you can kind of look for the average of where the market is hitting to determine the trend, right? Let's come over here. Let's look for like a really, really steep trend over here. You can start to connect some additional trend lines like this, right? So this is what we look for. Something like this would be a bullish trend. So we just simply connect 2 points on the chart, and then we draw that out, and then that gives us a trend line. And when the market comes to the trend lines, now that's not a good example, but let's try to get this trend line over here. So let's say I might want to use, you know, this point and this point. And then from there and there, I start to create a trend line, right? So I use 0.1 and I use 0.2. I made a trend line. So now when the market comes back to the trend line, that trend line serves as an area of interest where we might say, there could be a trend bounce that happens over here. This market is still in a bullish formation. It's still going high and low and higher high and higher low and higher high and higher low and higher high and higher low. And you know what? This is right by my trend line. There's a good opportunity that this market may react from that trend line, and it may continue in its bullish formation, and the market can keep going up. So this is how we start to develop those ideas of where the market is going. All righty. Now, from a trend line, we have something known as a channel. So what is a channel? So a channel is formed by drawing 2 parallel trend lines. And this kind of creates like a channel, which basically contains the price movement within a defined boundary. So as an example, so you see right over here, what we did was we used the trend line to determine the trend direction following the formation. But if we come over here, we simply copied that trend line. We made a parallel trend line, and then we just brought it to the high point. And now we have a trend channel. So this kind of serves as like an area where trend where the trend may be trading in. Now, is this something that's going to always happen in the market? No, absolutely not. But this is something that you're going to learn and uncover as you begin trading. So we're introducing these very, very simple concepts. So let's come over here and let's say, okay, what is a channel, right? So let's say I'm going to come over here. Let's say I want to use this point, okay? So I'm going to come over here. I'm going to create this trend line one more time, right? I'm going to go here to here, and I'm going to create that trend line, right? So I use point 1 and I use point 2. Now, what I could do is I can take this and I can simply copy this. So I can just click this trend line, hold Control-C, Command-C, Command-V, and make a copy. Or I can take that and then there should be a little, there we go. There'll be a little thing that comes up and then more. And then look, you can clone it or make a copy. Okay, and then now you have a 100% identical trend line. So what do you do? Well, what I'm going to do is I'm simply going to say, well, here's my first point. There's my high. And then there goes my second point, right? So I use these 2 points to create the trend. And then I just take this and I bring it right to the top of that wick, right? Right to the top of that high point. And now I make a channel. So as you see over here, you see this price is not only in an uptrend and it's not only above the trend, but it's staying within the price channel. Now, why are we using this? Well, we're using this because if we're looking to trade within the market, remember, trading is all about making decisions and you need information to make decisions. So this is why we start marking up the chart, because if this is 1 point, and this is the second point, that means that every single time the market comes back to this trend line, this serves as another potential area where I could potentially buy in the market, right? And the reason why I'm making a channel is because when the market comes to the channel, this serves as another area where I may want to potentially start to think of selling in the market. So this is trends and this is channels. Very, very, very basic concepts. Remember, these are introductory concepts to help you understand the structure of the market and how we start to use these concepts to maybe create a bias on what the market is doing and where the market is going. And we'll bring it full circle in a minute. Now, from trends and channels, we have something known as pullbacks and corrections in the market. Well, what's a pullback? So if we're looking at the market, this is what we would basically call like a trend interruption, okay? So pullbacks and corrections refer to price reversals within the prevailing trend. What is the prevailing trend? It means that if we're looking at the sequence and the market is going low and higher low and higher high, and that market is making an uptrending sequence, an uptrending formation, and maybe the market is also staying above the trend line, we know that we are in an uptrend. So that is the prevailing trend. The main trend is up in this particular example. So what's happening is this is a reversal to the prevailing trend. Okay, so let's read this again. Pullbacks and corrections refer to price reversals within the prevailing trend before potentially resuming the original direction. So traders often see pullbacks and corrections as opportunities to enter in trades in the direction of the overall trend, but at a better price. So if we're looking at something known as a pullback is a very, very simple thing. So a pullback refers to a temporary reversal in the direction of the prevailing trend, and it occurs when the price moves against the trend. So as an example, we see how the primary trend is bullish, and we see that the market is going up. But when the market starts to pull back against the prevailing trend, that is called a pullback. That's boop, the market is pulling back. And then the market resumes its trend, and then the market pulls back, boop. And then the market resumes its trend. So whenever we are in a trend, so let's take a look, right? Let's actually draw a, let's take a look at a much bigger trend. So let's say we're looking at a trend right over here. And I'm sorry, I know my candlesticks are not as fun for you guys to look at, right? But let's say we are in a trend and we see that the trend is bullish what do we want to do in a bullish trend? We want to buy in a bullish trend. That's why they say the trend is your friend. You always want to be able to identify the trend. So let's take a look over here. So let's say we're looking at the sequence of the market. We can see the market is low, the market is high, the market has a higher low, the market goes to we have a few here, a higher high and a higher low, and then a new higher high, and then a higher low, and then we have a new higher high, and then we have a higher low, and then we have a new higher high, and then we have a higher low, and then we have a higher high. So we could see that this is a bullish trend. Now, in a bullish trend, what's going to happen is the market's not going to stay bullish forever. Eventually, the market is going to have to pull back inside of the market. So as we see right over here, this is what we're looking at. We're looking at the market pulling back, right? We're looking at the market from here to here pulling back. We're looking at the market from here to here pulling back. We're looking at the market from this high to that low pulling back. We're looking at the market from this high to that low pulling back. Now, every time the market pulls back, this gives us a potential idea to say, hey, this could be a much, much better price to buy that market. When it pulls back, this could be a much better price to buy in that market. When this pulls back, this could be a much better price to buy in this market. When it pulls back, as an example, this could be a much better price to buy in this market. When it pulls back, this could be a much better price to buy in that market. So this is what we're looking for pullbacks for. We understand that it's when price is moving against the current trend, and then we're waiting for that pullback to complete to then say, here's a pretty good area where I might be able to jump into this market and gain some great profits. Remember what we talked about before, how we're doing technical analysis and we want to determine that entry price right over there, right? We want to determine that entry price and we want to say, okay, we need the entry, the stop loss, and the take profit. So looking at pullbacks, and when pullbacks are completing, these are going to be the things that's going to start to help you identify where those entry points are going to be within the market. Now, again, this is a very basic concept over here. Okay, so that's a pullback. Now, the difference between a pullback and a correction is a correction is just a much more significant price movement against the prevailing trend. And corrections are usually larger and they last longer. So as an example, let's say we're looking at the market over here. We could see that these small moves right over there are pullbacks. So small moves give us a pullback and give us another opportunity to enter in the market. But if you take a look at something like this, this is a much larger kind of pullback in the market, right? And it actually starts to look like a bit of a downtrend, okay? So if you're looking at the market, right, this looks like a downtrend over here, but overall, the trend was still very much bullish, right? So you have low and you have high and you have low and you have high and you have low and you have high. So can you see that right over there? So the pullbacks are just those small little pullbacks in the market, giving you opportunities to buy. Corrections are much larger pullbacks within the market, much larger. That's why they call corrections, because there's a huge market correction. And there's, as we learn and we get deeper and you guys go through more courses, there's going to be opportunities to sell in a correction market. Absolutely. But just like a pullback, when the correction completes, this gives you another opportunity to buy in the market and then get a nice, huge move inside of the market. Okay, so pullbacks and corrections are one and the same thing. The only difference is that pullbacks are smaller, corrections are much bigger, but they both serve as things that we want to notice to give us a potential setup, an alley-oop to buy into the market. Okay, now as we go here, what is support and resistance? This is another basic price action fundamental concept. So what is support and resistance? So support and resistance are key levels of interest that we're going to want to pay attention to that's going to also help us make informed trading decisions, just like trend lines and pullbacks, right? We're going to start to put these all together in a moment. So let's talk about support and resistance. So support and resistance levels help traders identify potential entries and exit points within the market for their trades. These levels are not fixed and can change over time based on the market dynamics, just like trend lines. As the market is making highs and lows and lows and highs and series of highs and lows, we're using all of those points to start making support and resistance lines, to start making trend lines. And that's why some people who are new to trading, who have no coach, that only understand these basics, but they don't understand how to apply the basics and how to specialize in these particular things, their chart starts to look like a circus show. And they got lines here and lines there and lines everywhere. And it's like everybody gets a line. I'm just going to call them Oprahs, Forex Oprahs, right? Because they don't know what they're doing. Their charts look crazy. But let's focus on the basics here, right? So they can change over time, right? So we use them subjectively, same thing like trend lines, all righty? But they do provide valuable insight into market behavior and help us to indicate a point of where buying and selling, but they will provide valuable insight into market behavior and indicate a point where buying and selling interests can tend to increase. So let's actually start to talk about what is a support. So a support refers to a price level at which a currency pair historically had difficulty falling below. This acts as the floor for price. So as an example, when price is coming down and it starts to hit a support, it starts to hit a floor that it's not really breaking through, this is what we start to call a support, right? So if we're taking a look at the market, let's start to remove these drawings over here. Let's look for a very, very, very strong support inside of the market, okay? Right? Let's, I need to find a really good consolidated range because we're looking at oil right now, right? So oil has some really good movement in the market, okay? Right? There's support everywhere on the chart. I'm just trying to give you guys like such a textbook example. It's not even funny. But let's take a look over here. Let's say we're looking over here. Remember how we use those highs and those lows to connect those two data points to create trend lines? We're going to do the same thing with a support and resistance. Now, for support and resistance, you can also get that trend line right over there, and you can make that like a horizontal line in the market. Other people, what they like to do is they'll sometimes come to the left, and then if we come down to, let me see, right over here, we come down to 1, 2, 3, 4, 5, 6. That 6th one down where the brush is at, you'll start to see there's this little thing called a rectangle. All right, so sometimes traders will use the rectangle right over here to start to develop a support. So if we take a look at over here, take a look at this. We'll notice that right over here in this range, right, price started having a historically hard time breaking below this. So what we did was we used 2 points, right? You have point 1 and point 2. We simply line up point 1 and we line up point 2 and we have a support. That's simple, all right? And we know it's a support because every time the market comes to that support, it gives us a bounce off that support. And it comes to the support and it gives us a bounce off of that support. It comes back into that support range, it gives us a bounce off of that support. It comes back to the support range, it gives us a bounce off of that support. That's a support. A support is like a floor, okay? And price will have a hard time getting through that support. So support also helps us understand the concept of what we would call buy high, sell high and buy low, or premium and discount, right? So if you're ever looking at a market, okay, what do they always say? They say, oh, well, if you're trading, you want to make sure that you're buying low, supply and demand, make sure you buy low. And when the market gets high, you want to make sure that you sell high. So you want to sell high and you want to buy low, and you want to sell high and you want to buy low. And that's kind of what we're seeing over here. Okay, these are the low points right over here that are going to start to help us, you know, say, hey, this is that low point. That's why it says it provides valuable insight. Pardon me for the word stuttering. It says this is where we provide valuable insight into market behavior, which indicates a point where buying and selling interest may tend to increase. So you might get a better reaction off of that support. And now a resistance is the same thing as a support, but the complete opposite. A resistance is simply when the market is starting to run into a high point and it has a bit of a hard time breaking through the high point in the market, right? So as an example, let's take a look over here. Again, I can use that trend line right over here to start to make a bit of a resistance inside the market, or I can use that horizontal kind of box right over here to make a bit of a resistance right over there as well. So it's the same thing. Now, every time that market comes into that resistance, that's a place where price is going to have an issue breaking through. And that's an area where selling interest may tend to increase. You'll start to see that more people are going to want to start to sell from those resistance points. Okay. Now, support and resistance is one and the same exact thing. Support becomes resistance. Resistance becomes support. It just depends what side of the market you are on. If the market is below the level, it's called a resistance. If market is above the level, it's called a support, right? So you'll notice as an example over here, let's say the market was trending. So take a real good look at this example, right? And take a look at how we started opening up this example. So watch this. We'll see here that the market was in a trend, and we use trends and we use channels as areas of support and resistance. If it's at the bottom of the trend line, that might be an area to buy. If it's at the top of the trend, which is the channel line, it might be an area to sell. Now, what we'll notice is that when the market is in the trend, the market will often pull back, right? So now if you look at this even further, you'll say, okay, well, if the trend line is acting like a support, and then the market ran into a resistance, right? And then broke above that resistance, creating that higher high, and now the market is pulling back, right? What happens when it pulls back? Potentially we want to buy. When it pulls back, what did it run into? It just ran into a give me 1 minute. Okay. So sorry, I had to remove somebody from the Zoom there. So now when it's pulling back, what happens? It pulls back, potential area to buy. It runs into a support line, potential area to buy. It has a support trend line, potential area to buy. So now when we're looking at this area, as you can start to see, we start to layer on these factors and we start to generate a bias and we start to generate an interest of wanting to buy at that specific price point. Now, does this make sense to everybody? You guys can go ahead and drop an 888 in the chat box if I'm explaining this, fairly decent to some of the newer people that are here. Okay, so that's a support and that's a resistance. It's one and the same exact thing. So as we come over here, pardon me, right? So as we come over here, you'll start to see that this starts to work like a bit of a staircase inside of the market, right? This starts to work like a bit of a staircase inside of the market. Let's take a look. So the market went from low, right, to a high point right over there, right? And then went low, and then the market went high. Now look what happened. When this was the resistance right over here, this resistance then became a level of support inside of the market. See how it became that level of support? So now as the price pulls back right over there, what was once resistance is now support, right? And we see it has trouble breaking through. So we might say, this might be a good area to potentially buy. And then the market goes above. And then now we can start to develop maybe somewhat of a trend line in the market. Now, obviously, see how trend lines are subjective. So sometimes you could use them here and sometimes you could use them there. But the best thing to do in these areas is start to overlap them. So you'll take what is a resistance, which became supports, and you could see it right over here. This was resistance over here. And then what was once resistance now became support. So it's one and the same exact thing. So look at how the market is following the sequence. High, higher low, higher high. The market is pulling back against that prevailing trend. It's pulling right back to the support line, right back to the trend line. So now, again, repetitiveness. This might be an area of interest where we may want to start buying out of that area. So these are the most basic fundamental concepts when it comes to price action trading. Now we can specialize in these. We can go so much deeper into these things. There's so many more advanced price theories that you guys are going to learn, but these are really just the simple things. Now, what is consolidation and contractions inside the market? So consolidation and contractions basically represent market indecision. So let's talk about this. So consolidation in the Forex market refers to a period when consolidation in the Forex market refers to a period when the price of a currency pair starts to move relative within a tight range, showing little or no trend. So it's not trending anymore, right? So you take a look over here, you notice here on this previous slide, the market was trending, but if you see here on this slide, the market stopped trending. The market started getting trapped in between levels of support and resistance, and it just started having somewhat of a sideways market movement. This is what we call consolidation. This is like indecision inside of the market. So during consolidation, all right, the price fluctuates within a specific price range, often forming a horizontal channel or a rectangular pattern on the chart. Now, it will not always perfectly be horizontal. Sometimes it'll start to contract. So consolidation occurs when the market is indecisive with buyers and sellers in equilibrium. So there's an equal amount of buyers, there's an equal amount of sellers, and the bulls are not overtaking the bears. The bears are not taking over the bulls. They're just stuck kind of in a range, and they're figuring out what their next move is going to be. So traders often interpret consolidation as a period of market rest before the price resumes its previous trend. Right? So as we're coming over here, let's remove some drawings, and then let's take a look right at different areas. I had some other examples over here. Okay, all right, let's just try it down here. Let's take a look over here at consolidation, right? So if you're taking a look at the market, you can see from this low point to that high point right over there, this is what we would call consolidation in the market, right? We could see here on the left-hand side of the screen that the market was in fact trending. The market went from high to low, to lower high, to lower low, to lower high, to lower low. It's clearly in a downtrend, but over here, this market is kind of just like going back and forth within this range. That is known as consolidation. So that's when the market is kind of taking a rest. Buyers and sellers are not really in control, but eventually when somebody takes control, the trend will resume. So here we can see that the sellers took back control because now the market broke below and we have a lower low and a lower high and a lower low and a lower high and a potential lower low and now a potential lower high. So this is consolidation right over there. Now, the difference between consolidation and what we call a contraction, contractions are different forms of consolidation. So traders might observe reduced trading volume and decreased market volatility. So the market's really going to start to tighten up and you're not going to see much market movement. And you're going to say, man, what is going on? I want to make some money. I want this market to go, but it's not moving. Well, the market is most likely contracting, right? And you're getting reduced trading volume and reduced volatility. And this situation often precedes a significant price movement after. So if you take a look over here, let's say we're following the market, you see here, even though this whole sideways move is a consolidation, look at how the market started tightly contracting between the support line and the resistance line. It started bottlenecking through, right? So if we start to take a look at a contraction inside of the market right over here, okay, let me find a decent little contraction. So I have lots and lots of stuff to look at over here. So sometimes it's hard to see everything when you're looking at everything so quick. Let me just kind of stick to the real time over here. Let's remove this. All righty. So contracting. Let me see if I can turn this consolidation into a contraction. Let me see. This is a big one over here, right? Right. So here we go. So we'll use something like this just for the preservation of time. So if we take a look at over here, I'm starting to connect these high points and these low points right together. And then what you're noticing over here is you're noticing that the price is starting to contract. The price is starting to tighten up, right? It's going from these big swings and it's creating smaller and smaller and smaller and smaller and smaller swings inside of the market, right? Let me see. Contraction. Could be a little bit well, we see contraction all day long, but this oil market is not doing much contraction over here. But let's take a look over here. You see here, right? Here is the price contracting. See how this price starts to tighten up? It starts to bottleneck within one area. It starts to contract. That's a form of consolidation. And usually when you see a contraction, it's different from the market taking a rest. It means that the market is just building up a bunch of volume, because what precedes a contraction is usually a huge, explosive market move right after that. And you can see here, you're able to get lots and lots and lots and lots of pips on that market contracting. So that's consolidation and that's contraction. So now when we start to put all of this together, all these price action concepts that we start to put together, we're going to bring it full circle because we're getting ready to close out this training, right? But as we start to bring this full circle, what this is called, what all this price action is called, this is called market structure. It's understanding the structure of the market. So let's talk about this as we start to bring this all together. So market structure refers to the structure of the market. It's a commonly used term by traders who are able to identify who's able to identify the series of highs and lows to detect the current market trend, the changes in trend, and utilize that data to start making informed trading decisions. Okay. So as an example, let's say we're looking at the market over here. Look at the structure of the market. Right? When you're understanding the market structure, what is it all about? It's all about those high points and those low points. We use those highs and those lows to see the trend moving up. We use those highs and those lows to start creating trend lines. We use those highs and those lows to start creating levels of support and resistance. We use those highs and those lows as areas of interest, right? That's what we use those highs and those lows for. So as we start to better understand the sequence and the formation and we're looking at that, we can start to understand the market. So as an example, let's take a look over here. Look at the structure of this market. This market was going from low to high to higher low to higher high to higher low to higher high. So we know that that was a bullish formation. That market's in an uptrend. But suddenly the structure of the market changed. There was a change in character. So what happened was that market went from a higher high to this market started coming down and it created a new low. But this low was lower than the previous higher low. So we're instantly able to recognize that, hey, this market might be changing from an uptrend to this market might now be going into a downtrend because the market has just now made a brand new lower low. And what comes after a lower low comes a lower high. And from a lower high comes a lower low. So you can see right in this one area, we can see that the sequence, the structure of the market changed from bullish to bearish. So market structure allows us to instantly recognize the changes in trends when we're looking at the highs and the lows in the market. Now, additionally, market structure, as we just discussed, market structure is going to help the traders identify ranging and consolidating markets, trading within trends and channel, approaching key levels of support and resistance, right? And more. All of this here, this is what we call kind of like understanding the order flow of the market. So let's come over here for this one final example as we start to bring this through. When we're looking at the market through and through, now that you guys have went through these basics, let me change the time frame here. Through and through, now that you guys have went through the basics, what do we understand, right? So let's talk about this. We understand one, right over here, pardon me, and my horrible drawing, right, guys? So we understand one, right? The FX market, right, is a market where we're able to participate in as long as we have a laptop and a computer connection and we have the skills of trading. We're able to participate in this market, which is worth $6.6 trillion every single day. And we know that when we're in this market, we need to start to use technical analysis, right, to start to identify where we want to buy and sell in the market, because that's the whole name of the game. Where do we buy and where do we sell? Okay. The second thing that we understand from this is that we simply need some trade management, right? We need some trade management inside of the market. We got to make sure we have trade management. We got to make sure that we have risk management inside of the market. Okay. These are the things that we understand, because now when we come to the market, this brings us to one very, 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 very simple conclusion. The name of the game in the FX market is where do I buy and where do I sell? That's the whole name of the game. That's what the strategy is about. That's what this whole entire boot camp is about. That's what you're coaching and getting on the live sessions and trading and earning money, the whole nine. This is what it's all about. Where do I buy? Where do I sell? Because I want to make money. And what we do is we start to use these concepts. So watch as I start putting these concepts all together. Let's take a look at the market. The market right over here is going from low to high to low, right? To high to low to high. That market is in an uptrend, and in an uptrend, I want to buy here and I want to buy there. That's what I want to do. Okay. In this market, this uptrend has now started to pull back. Okay, right over there. And after this market pulls back, I want to buy right over there. And I want to continue that trend. And this market's going to continue to go high and low and higher high and higher low and higher high and higher low and higher high. And what do I want to do? I want to buy every single time that market pulls back. Because when that market pulls back and I'm going in an uptrend, I want to get in at the very, very, very best price. I want to throw in my entry, my stop loss, my take profit. I want to put it all together, and I want to find out, well, where do I buy and where do I sell inside of the market? That's what this is all about. Just identifying when the market is high, when the market is low, when are we buying in an uptrend, when are we selling in a downtrend. And if you guys are able to get really good with that, you guys can earn a lot of money. One more final example. Watch this. Ready? What do we do over here? If this market is going from low to high to low to high, what do we have over here? Potential uptrend. And what do we see in this potential uptrend? We see a potential area of support and resistance, right? We see a potential area of support right over here. Now, if we're in an uptrend, we only want to buy in an uptrend. But then what happens when the market starts to change the structure? This market now went from creating a higher high, a higher low, and a higher high, and it pulled all the way down to making a new lower low. This low is lower than that low. So what does that mean? This market might be turning over. So if the market's turning over and the market's going to start going down, what do I want to do in a down market? I want to sell in a down market. So if I want to sell in the down market, do I sell when the market's low? No. I want to wait for the market to pull back. Okay. I want to wait for the market to pull back. And then when the market pulls back, I want to kind of find these areas of support and resistance right over here, because these are going to give me a good area to potentially sell. And now I have a new potential lower high. And now I can potentially say, you know what? I now want to sell. Bingo, right? Without anything specific, this is how we start to identify buys and sells inside of the market, right? This is really what it's all about, ladies and gentlemen, okay? Now, the final two slides that we have over here are something known as indicators. Now, being over here within the market, okay, what we're doing, all this price action, all of this stuff, this is called naked trading. So you guys are going to be doing a lot of naked trading, and that does not mean that you are going to be stripping down to your bare minimums and in your birthday suit. No. Naked trading means that you're simply using price action. You're simply learning how to understand price and how price is moving, and you're starting to make decisions based on that. That's price action. That's what we just taught you about. Very, very basic. But guess what? We're in 2024. There is technology, there's math, there's all these great things going on. So instead of having to only do price action, we're going to introduce another concept to you that's going to help you in your trading, which is known as indicators. So indicators are these mathematical, because it takes math to make an indicator. So indicators are these mathematical calculations based on historical price, volume, and data. That's all the fancy stuff, right? These calculations are used to analyze trends, patterns, and help you predict future price movement. So traders use indicators to gain insight into market behavior and make informed trading decisions. So think about it like this. An indicator is going to indicate to you what the market is doing. So as an example, let's say I'm looking at this market and I wanted to throw some indicators in. Right? Where is all of my, no way, this thing really just did that? Okay, let me try to use, can I use this one over here? All right, so let me use this one over here. These are one of my old things. Let's use regular Smartwatch version 1. Right, this one. Okay, there we go. Very, very easy. Okay. So let's take a look at this. So now we have some indicators on the chart, right? So let's put maybe like 21 or something like that. Where is okay, why did my indicator disappear? Okay. All right, my indicator, I don't know. I think my Tradingview is like glitching. It's like so weird. Why would that not show up? Let's come over here. Let's try the McGinley. Let's add another one to the chart. All right, so this Tradingview is definitely bugging out because my McGinley is not showing. All righty. But anyway, an indicators are these different type of things. So these type of indicators, now you have oscillator indicators, which is what you're looking at down here. You're going to have some indicators that's going to be here on the chart right over here. And when you go to Tradingview and you click on indicators, you're going to notice that when you come to technicals, there's going to be lots of different indicators over here. So a very popular one is using a moving average. So I want to have this moving average come up so that way you guys can see it. Super MMA. Let me see. This is coming up. Something went wrong. All right. So there's something going on with my trading. So let's refresh this here quickly. All righty. DXY. Let's go back to oil. Okay. So there is something going on with my thing, but it's all good. So let me try to put something over here. All right. Let's try to change this one. So let's put like a 20. All right. So my, I don't know, I guess it must, because I'm doing my templates. All my stuff is like glitching over here. But anyway, guys, look, these indicators will indicate to you, right? What an epic fail. But these indicators are going to indicate to you what the market is doing. So like as an example, let's say you're wondering and you're saying to yourself, when is the market high? Let's say I'm looking at like very basic. Let's say I'm looking for a resistance in the market and I want the market to come to that resistance. And I want to know if the market's going to start coming down. Well, when you start to look at some of these indicators over here, I'm just going to show you one. When you start to look at some of these indicators will help indicate what the market is doing. So look, let's take a look at this. And these are going to be the things that's going to help you make decisions. So look, you have the market goes low and the market went high and the market went low and the market went high and the market went low and the market went high and the market went low and the market went high. And then the market came back low and the market went high. So if you end up looking at the indicators, it almost does the same thing. Look, it goes low and it shows you when it gets to a high point to potentially say this is an area to sell. And now it went to a low point. There's a potential area to buy. And now it's at a high point, potential area to sell. And now you see over here, you see how this market is like working its way down, but this wasn't. So you see something is off. So you got to want to use them in relevance to each other, right? Now you see over here, that market went back to a high point. And this market was at a high point, and then I was able to sell down. And then this market was at a low point, I was able to go up. So if you take a good look, you can kind of get like a really, really good feeling. So you can see that, like, look, this price, this over here, let's take a look. You can see that right over here, this was kind of like an area of support at a low, right? And then the indicator was at a low. So they're both at low points, telling you that the market can potentially push up. And then if you look at over here, you see that this is at a resistance, that's at a high point. And then you can see that the indicator here is also at a high point. And then that's a potential confirmation that you can start to push the market back down. And you'll see when the market came back over here to this level of support, this market was also at a low. And then you had an opportunity to go back to the high. So you guys are going to start to learn all about different indicators as well. We specialize in 4 types of indicators, which we're not going to get too deep into it, but we have trend-based indicators, volatility, momentum, and volume. There are thousands of indicators around the world, thousands. When you start to come here through Tradingview, you guys are going to geek out. You guys are going to see a million different type of indicators. Literally, I think there's like 400,000 different type of indicators, but they all do the same thing. They will either tell you what the trend of the market is, the volatility, the momentum, or the volume. And what we do is traders will often combine indicators, right, to confirm signals and make more accurate predictions about future price movements. So if I'm looking at a pullback and I'm at a trend and I'm at a support in a basic concept, and then I got a few indicators and my indicators are telling me to buy, this is how the newest trader can simply say, this is an area where I could buy. That's an area where I could potentially sell, proper risk to reward, manage my trade, so on and so forth. Now, however, it's important to note that no indicator is perfect. And that they should use this in conjunction with other forms of analysis like I just talked about, and obviously always use risk management for effective trading decisions. All righty. So we're going to get ready to start wrapping up our boot camp. I know today we had a very, very long course, but that's because we kind of went into some more specifics. And for those of you that this is your first time getting introduced to the market, we wanted to create a little bit of a foundation of some of these basics. So that way you can start to come over here and just get a little bit of a general understanding of what the market is doing and how we start to come to these decisions to forecast where the market is going. Now, remember the difference between somebody that's new and somebody that's a professional specializes in price concepts. So those concepts, these concepts that I just introduced to you, I do keep them in my mind. I do think about them. They play a very specific role when I'm making decisions and I'm trading in the live market myself, right? But as you start to really become a professional, you're going to start to specialize in specific price concepts. And you're going to start to look for these very, very, very specific things. And then those specific price concepts are going to form your strategy. Because remember, you can learn and learn and learn for years and years and years. You can stay on these YouTube videos forever. You can go to all these forever. But if you want to really specialize in Forex, you want to develop a real strategy in Forex, you have to work with a coach or a mentor that has figured out a winning strategy. And then they are able to give you the tangibles and the specifics. Do this, this every single time with this risk to reward. And then now we can have, you know, a profitable trading track record. That's what we do over here. That's what we've been doing for the last 8 years. That's how I've been able to help coach and mentor over 600,000 people in this entire career that I had. So remember, this is basic concepts. So if you guys want to continue learning and you guys want to become better at trading, you definitely want to reach out to us to be able to be a part of our trading community and get access to our live sessions, to get access to our market analysis, right? To get access to our specialized strategies and our specialized trainings well beyond all of the basic stuff that you're learning here today. All right. So just to recap, today we went over Tradingview and how we can use Tradingview to start interacting with the market. We introduced price action concepts, which includes things such as highs and lows, using higher highs and higher lows to create uptrends, using lower lows and lower highs to understand the formation of downtrends, to explain what trend lines and channels are and how they can aid us in our decision making, what pullbacks and corrections are. So we understand we need to see pullbacks and corrections to get in the market of the prevailing trend. We also went over support and resistance and how these serve as key areas of interest where we may be able to buy and sell. We talked about contractions and consolidations when the market is kind of just like taking a rest. It's not moving up. It's not really moving down. It's just kind of doing a little bit of a sideways. That's when we stay out of the market because we like to trade with the trend. We talked about the concept of market structure, which is just putting all this together and understanding the overall structure of the market. Hey, the market is trending up. I'm looking for buys. The market is trending down. I'm looking for sells. The market's pulling back to a support. That's an area to buy. I want to overlap a trend with a support and some other key concepts, yada, yada, yada. That's the structure of the market. We quickly introduced indicators over here to you guys as well, and how indicators can help us indicate what the price is doing and how you could start to combine indicators with your analysis together to make more informed trading decisions. And we helped you guys understand that if you do start to go into the indicator route and you start to look at thousands of indicators, to not fall into that rabbit hole, because there's only 4 types of indicators and you have to know how to put them together to have a really, really good strategy. All righty. So that's going to be everything over here today. That's going to recap course 4. So I want to thank everybody so much for tuning in today. I hope you guys really just got an immense amount of value. I hope you guys really found this extremely helpful and extremely insightful. So again, my name is Manny Q. We just completed part 4, volume 4 of the FX Breakthrough Bootcamp. All righty. Tomorrow or on our next session, we're going to have our final free lesson for the FX Breakthrough Bootcamp. So we look forward to you guys being there. I look forward to seeing you guys on the next lesson. And remember, if you guys want to get access to further education, more of our strategies, more of our boot camps that start to specialize in price, make sure that you're reaching out to us to get involved with our trading community. So guys, thank you so much for being here.